When global conflicts erupt and oil crosses $100 a barrel, investors reliably flock to safe haven assets. Historically, gold and silver reliably spike during these periods of extreme uncertainty. This line chart shows exactly what happened in early 2026. As the black line representing oil prices surges upward due to a massive Middle East war, the gold and silver lines violently plummet. Silver dropped 35% in a single day, and gold suffered its steepest weekly decline in decades. Mainstream financial media dismissed this wipeout as a natural market correction, framing the sudden evaporation of billions of dollars in wealth as a routine cooling of prices. But the timing of the collapse defies that explanation. The ultimate safe haven assets became the most dangerous place to park capital during a peak global crisis. The mainstream narrative fails to account for the trading data recorded at the exact moment the market bottomed. Major investment banks, led by JP Morgan, executed an incredibly precise maneuver. They closed out a $10 billion short position, a giant market bet that the price of silver would fall, at the intraday bottom of the crash. The stakes were massive. If silver had continued its climb, the unrealized losses on those shorts threatened to trigger a systemic collapse of the CME clearinghouse. The CME is the central entity that processes and guarantees all trades on the exchange. The 2026 crash functioned as a calculated, brutal rescue operation designed to protect the financial system's largest players from total liquidation. In early 2026, retail investors drove silver to $120 an ounce, fueled by a collective fear of missing out on a massive rally. This parabolic climb created a crisis for institutional banks. They had built enormous positions betting silver's rally was impossible to sustain, and this retail momentum left them trapped with billions in potential losses. These banks faced a buyback dilemma. They needed to exit their short positions, but buying back that many contracts in a functioning market would have launched the price of silver even higher. To survive, these institutions needed a massive pretext to trigger a wave of panicked selling from retail investors. That pretext arrived in the form of a geopolitical shock. With oil hitting $100 a barrel, global markets were suddenly terrified of runaway global energy inflation. Then came the war shock. Kevin Warsh was nominated as the new Federal Reserve chair, sending a signal that the era of easy money was over. Investors immediately expected higher interest rates for a longer period. This caused the US dollar to strengthen rapidly, which crushed the appeal of holding gold and silver, assets that do not pay a yield. The convergence of high oil prices and a hawkish Federal Reserve created a psychological smokescreen, allowing the paper market reset to begin. The actual mechanics of the crash relied on a vulnerability called portfolio margin. Modern hedge funds and traders pool volatile assets, like cryptocurrencies, together with stable metals in a single margin account to use as collateral. The trigger was a sudden, violent $1.68 billion liquidation crash in the cryptocurrency markets. This crash forced a margin call. A margin call is a broker's demand that an investor deposit more money or sell assets to cover potential losses. When crypto plummeted, brokers forced traders to liquidate their most stable, liquid assets, gold and silver, to raise cash immediately. The system then piled on the pressure. The CME hiked silver margin requirements by 25%. Simultaneously, key trading systems at the London Metal Exchange, or LME, and HSBC mysteriously went dark. This mechanical cascade of forced liquidations created an overwhelming wave of panicked supply. It gave the banks the exact liquidity they needed to close their $10 billion short positions without spiking the price. In the end, the physical silver shortage and the geopolitical realities of the war proved to be entirely irrelevant to the market's trajectory. While Western paper markets engineered a collapse, Eastern markets experienced the Shanghai flip. Physical demand for actual metal in places like China remained incredibly strong, even as the paper price fell. This disconnect demonstrates a concept called monetary gravity. In a systemic liquidity crisis, the market abandons the concept of safe havens and ruthlessly prioritizes pure US dollar liquidity above all else. There is a difference between holding a physical bar of metal and holding paper contracts that can be manipulated by exchanges and clearinghouses. If you hold paper assets in a highly leveraged system, you aren't actually participating in a free market. You are simply the exit liquidity for institutional giants.